Please speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
Saturday morning, welcome back for another weekly market recap. We just ended another week, but on the other side, we started a new month. So happy August, all of you. Was a week full of events. The economic calendar was particularly busy. So let's waste no time and let's just, jump straight into it. So let's start out chronologically as usual, getting back to the beginning of the week, or the first relevant data point released this week, which was job openings. Now they remained particularly tame, as you can see. They're staying in this range. So after this huge downtrend from 2023, over the last 2 years, more or less, they didn't really recover. So it's not like you have new job positions actually being added. I know that if you just look at the data month over month, you might have, quirks and spikes or blips or dips here and there. But if you then zoom out and you look at a trend, it looks like they went down like a lot and they stayed down, which, as usual, it would suggest at the very least the situation in the labor market, which is a little bit stagnant after being weak for quite a bit of time. So not a huge positive for me in this case, right? But that is nothing new. Moving on, we got ADP employment change. Now we actually see a rebound into it, and as you can read, 104,000 jobs were added in July, so it's kind of like a good or a positive, a bright note if you consider that it's the strongest gain since March and it was above expectation. But still, if you check, the previous month of June was downwardly revised. So, now we are getting into that part where revisions start to kick in, and it's going to be even more pronounced. A little bit of a spoiler alert there when we get into NFP, right? So let's keep on moving with order. Now, we got the GDP report, right? And when I saw it, I was like, man, that's a huge beat, right? It came in at 3% after being negative in the first quarter. Now, I don't know if they revised the first quarter because I did remember not or negative 0.3 and now it's telling 0.5, so maybe there were revisions even in there, but regardless, the I guess the big surprise was this 3% because how could it be, right? How can you explain it was negative in the first quarter and now it's massively positive? It's beating expectation by what, 40, 50 basis points. Now, as we observed way back in the days, like 3 months ago at this point, when we were talking about GDP for Q1, do you remember what we were saying? Just pay this data point with a huge grain of salt because the distortion that tariffs brought to the table. If you think about the formula of GDP, right? What is that? It's consumption plus investment plus government spending plus the net result, so the difference in between exports and imports. So the net exports, if you want to look at the different variables in a in a positive connotation, as if in you had to sum up all the whole, right? So net exports, if you remember, we were talking about the front run of tariffs in Q1. So essentially, what happened, as we discussed, it was that companies were building up inventories, and consumers, they were basically pulling demand forward. So what we said was, well, but if all that demand it's pulled forward, you might have a payback period. Or in other terms, if everyone which was willing to buy whatever, inventories for company or goods for consumers, if everyone is already buying now, who's going to be left to buy later on in the second quarter? So if you think about the formula, if you think about the phenomenon and the distortion which was added by the tariffs, or by the assumption that tariffs would have been introduced and therefore we could potentially could have had a little bit of an inflationary pressure. Now, it, what happened in the end is that basically Q1 results were offset by Q2 results, right? Net exports in Q1 reduced GDP by 4.60%, but in Q2 they added almost 5%. If you think about the difference, right? So that is just that dynamic. Demand was pulled forward. Therefore, there is no one which is willing to buy now. So at the end of the day, if you just think about the net exports component of the formula, it was a wash. Net, they evened out each other, right? So you could look at the entirety of the first half of the year as just one period and saying that Q1 was offset by Q2, so it's just a wash at the end of the day. If you exclude the export and imports component, at the end of the day, what you might see is that the other factors just contributed to give you our result as for GDP overall, which was slightly above 1%, which of course is not negative, so you can't really talk recession, but it's still testimony of an economy which is slowing down or cooling down, right? Now, the pace and the rhythm, the tempo at which it's cooling down, it's still out there for debate, but sure as hell, as I kept on saying until I was blue in the face, these all the data you can look at since the beginning of the year, basically, they were not suggesting a booming economy or a red hot economy, and therefore no particular worries over inflation. All right, now let's check GDP. Now it's now looking at a 2.1% estimate. Now again, we are just at the beginning of the next quarter, so I don't I don't know what type of relevancy you can put on it, but I do still remember my final estimates for GDP on an annualized base. If you remember 2 weeks ago, I'm on the record saying I was expecting it to be in between 1.8 and 2.3% at the end of the year for 2025. So it looks like for now, at least with the estimate, we are right in that range. We'll see at the end of the year. This is something that you can't really assess month over month. It doesn't make any sense. Again, because as you just seen, there are many things which could impact and basically fudging the data around and being misleading. All right. Then moving on, of course, we got FOMC. So the Fed and Powell, they kept rates where they were. So no cuts, no nothing, still on hold. We have been discussing this thing for a while now, in between Powell being fired and not being fired, and the spat in between Powell and Trump and all the rest. But if you remember last week, the assessment at the end was, well, I don't think they're going to cut. I think they should cut, and I think Bowman and Waller, they got a point, right? When they say that, considering all the worries and all the data which are coming in, it should be the time for a cut. Now, if you check the latest Powell press conference after FOMC, he got a few points, right? I mean, he kept on saying that, in his view, at the very least, and anyway, the majority of the board, right? Because we just got two votes against it. By the way, a little bit of a funny anecdote. This is the first time since 1993, if I remember correctly, that we got two dissents on the board, right? So just a statistical curiosity there. But Powell, anyway, he thinks that, given the fact that the economy it's still not acting as monetary policy is restricting, he thinks is a good, is a good path ahead to keep rates where they are for now, right? Although he kind of acknowledged the downside risk, all right, especially in the labor market, as he said. Now, he kept on saying the labor market is growing at a lower pace, but it keeps on growing. So he sees it as solid, or I think he said balanced, but anyway. And again, spoiler alert, NFP didn't really confirm that view, did it? Right? But that's for later. Now, he was asked about a potential rate cut, and he said he'd or at least they didn't make a decision. Of course, they want to see the data as if they are not looking at what is coming in the first 6 months of the year, right? And then, it's still too early to evaluate or to assess the impact on inflation, which may or may not come from tariffs. At the end of the day, the one point that for me was kind of interesting and kind of contradictory, it was that he kind of ended up saying that there is a strong base case in his view. These are his words, right? There is a pretty reasonable base case for tariffs inflation, right, to be a one-off. So just like a one-time event, and that's it. Which again, even in the same press conference, you transition from saying you still have to assess what's going to be, but your strongest base case is that it's going to be a one-off. But again, if it's going to be a one-off and all the rest of the data are suggesting a slowing or a cooling off economy, why aren't you listening to Waller and Bowman? And again, as we said, it looks like we are repeating last year all over again. They don't cut in July, August, they don't get the chance to do anything. And then in September, if the data keeps on deteriorating, they need to step in and cut 50 basis points all at once. Uh, I, I I don't know how much credibility you could lose. Again, if for the second year in a row you put yourself in the same type of a trapping scenario, but as I said, that's their decision to make, right? And I wouldn't, and quite honestly, I wouldn't trade my place for Powell. It's just, it's not an easy job, right? Let's always remember, it's not an easy job when the entire world basically is looking at you and judging you on a constantly month by month, and if everything goes wrong, they're all ready to blame it on you, right? Anyway, it's undeniable that to me it's at least he is a little bit short-sighted, maybe, or maybe stubborn, or maybe nobody has the proof for it, but would you say the Fed is not political and he doesn't want to cut because if he cuts now, it's gonna seem like he's bending the knee to the administration and therefore threatening the Fed independence. So he's really waiting for the data to be so bad that at that point he's gonna cut because the data are suggesting that, not because the president it's demanding that, right? Anyway, let's move on. Personal income, again, another rebound. So you might say, cool, right? Although, over the last 5 years, it was relatively flat. Now, you might say, if it's flat, at least it's not deteriorating. Yeah, that's true, but it's been flat for 5 years. But over the last 5 years, we had a huge, inflationary spike. So that just means that consumers most likely are not keeping up the pace, or at least they didn't keep up the pace with inflation over the last 5 years after the pandemic. So, overall, still not a good thing for me. And if you look at the other side of the coin, you see the amount, as we discussed last week, the amount of margin debt as a percentage of personal spending now, right, or consumption. You see credit card delinquency rate. So, I mean, it's not cool in my view. Now, personal spending, now that we think about it, what we see is that basically we got, well, even in here, a little bit of a rebound, a tiny one, but still heartbeat, flat heartbeat chart in my view over the last 5 years. So again, consumers have been kind of resilient. Depends if you want to look at the glass half full, but did they really go on a, uh, outrageous type of a spending spree? Doesn't look so, right? So then we got initial jobless claims, which again, they're coming down a little bit, and they kept on coming down basically since the end of, or the beginning of June, and same for of course, the 4-week average. But what I keep on looking at, it's the continuing jobless claims, which are remaining particularly elevated. And again, for me, this is a data point which holds a particular relevance because it just shows you that many people are hitting the unemployment line and they're not coming off of it. So it still tells you that maybe there's not so much jobs, or there are not so much jobs out there for you to pick. Otherwise, you wouldn't remain on the benefits, right? Now, we got PC, and again, this one too, it saw a little bit of a rebound overall in the context of ranging behavior. The month-over-month value stayed, the month-over-month change stayed in this range in between 40 basis points and zero, basically. So not huge. If you look at the annualized type of change, again, you see it's particularly flat. So even in here, should we be worried about a resurgence or an inflation renaissance? I don't think so, especially because inflation also had the PC index, supposedly true value, which is 2.20 more or less, versus what we've seen here, 2.6. And of course, headline CPI, it's now almost 40, about 35 basis points below target as set up by the Fed, the 2%. While inflation is what, 2.5? Well, I don't remember the last print. Maybe 2.5, maybe 2.6, but it was a bit higher than usual. And even in this case, you're looking at true inflation diverging about what, 80, 100 basis points compared to the establishment. Um, so again, I don't see the inflation fears Powell is looking at. All right. Now here the big kahuna for the week, NFPs, which came in. The thing is, if you look at the consensus, right, it was expected at 110. It came in at 73, which was of course better than the previous month. But don't forget, the previous months saw huge revisions to the downside. I remember it was what, 139 back in June, and it was revised down to 19k. And we got 147 in what was June. I know, so June was 147, revised down to 14. And I think that we got the prior month, which was cut by 150k, but because I think it was 139, it was revised down to around 20k more or less. So I mean, huge revisions to the downside. Um, I I know. I just laughed when I saw that because you got Powell saying the labor market it's still balanced in his words, and right the day after you see these massive revisions that basically, if you look at it in the entire context, it's just telling you that we lost a huge chunk of job. And if you pair it up with the household survey, which by the way, it's at least for the last 3 months, I guess, it's showing you a net loss of all of more than 850,000 jobs. It looks like that divergence in between the establishment survey as for NFP and the household, it's been resolved to the downside. Therefore, the establishment one kind of catching up to the downside with the household survey. And historically, that have been the pattern every single time. So you know, I guess this is not good. This is not. This doesn't. It doesn't look good for Jay Powell. Right after he came out saying, "Well, nothing to look at here. Move along. It's so cool." You know what? Just in the meantime, while I cast these people away, you just sweep it under the carpet for me, please. Don't talk about it, right? So, I don't know. It's not cool. The labor market, it's just it's not balanced out for me. It's not resilient. It's just deteriorating more and more and more by the month. But again, I'm not Jay Powell, so it's not my decision, right? Um, Unemployment rate still in this range. I mean, it got back to 4.2, but it's been hovering around these levels since last year, basically. August 2024, it was already here, and then it just went sideways in this range. The problem again, if I manage to find it back, is of course that Hourly earnings, they kept on staying particularly stagnant, and you could add to this the same type of logic as for the personal income and personal spending, right? And same goes for the average, sorry, the hourly earnings year over year. As you can see, they came down and stayed down. And then what you got, weekly hours, so then the amount of hours that you actually worked. So not only every hour that you worked was paid kind of, in a stagnant way, but over the last 5 years, overall, workers have worked less and less and less hours. And again, remember that we got inflation starting 2021, and it was particularly high for a good chunk of time. So they didn't really keep up, right? And then this, when you look at the unemployment rate, if you don't pair it up with these, right, if you adjust the unemployment rate of 4.2% with the labor force participation rate, what you get is basically the unemployment rate, when you adjust it, it should be slightly above 5%. But Powell is saying, well, it's due to what he called the immigration policies, right? Therefore, you see a little bit of a shrink in the workforce, in his view. Look, I'm not I'm not gonna say he's absolutely right or absolutely wrong. I'm just saying, wouldn't you be open to consider that maybe we are looking at a labor force participation which is slowing down because there are actually no jobs for them, and therefore they're just throwing in the towel, right? Is it something that at least could be worth to be considered? But no, for Powell, no. But again, because he can't tell you that straight away. Otherwise, as we've discussed in the past, he would be the catalyst for, the so-called panic or further an increasing economic contraction, right? So we then got ISM manufacturing PMI, which came in, as you can see by the chart, as a little bit of a weak data point. And still, we can appreciate the euphoria after the election, October, November, December, right? January. We're going to bring back manufacturing to the US. Yeah, and everyone was happy, of course. And then after the actual, how do you call it? When the president actually takes office, inauguration, right? It was just, faded all the way for the next 6, 7 months. So, again, at the very least, the intentions might be bringing manufacturing back. So far, the results are pretty dull, in my view. Now, again, if you then look at the employment component of the ISI manufacturing report, it's plunged. It plunged, well, again, back to July 24 lows. So I don't see how you could consider it a positive. And closing down the week, we got the United States Michigan consumer sentiment data point. A little bit of a rebound as we've seen the previous month, and it stayed particularly stable, but nothing really huge. And we already talked about the discrepancies in this type of survey. As for any other survey in macroeconomics, it depends a lot on how you ask the question, to who you ask the question, what type of question you ask, because it's particularly easy to get the answers you want depending on how you quote unquote manipulate the question you are making, right? So the results of all of this is, of course, the market now pricing cuts for September, still on the low side of the spectrum because we got an 80% probability which we are gonna see no cut. Or no, wait, maybe I'm reading it wrong. What's the current? Oh no, actually, yeah, I was reading it wrong because we are currently at 4.25, 4.50% as for the range. So 80% probability of a 25%, sorry, 25 basis points cut in September. Hmm. I wonder why. It might be because of what we have been discussed over the last 3 months, maybe. I don't know. If you look at the break evens, they are still pointing up, but again, the data are not really supporting further inflation pressures into the future. So might be we could see a reversal in them, right? And all in all, credit spreads are still particularly low. So at least there is not, or at least it's not an evident perceived risk in the credit market. Now, let's just conclude the parentheses, a huge parentheses this week on the economic calendar, and let's move on into charts, shall we? Let's start out with the DXY as usual, and surprise, surprise, right? Beside the potential uncertainties at the lows, and we weren't particularly sure that this was confirmed higher low. We would have needed confirmation. The trend was still at the end of it to the downside, so maybe slightly biased to a much more neutral slash a little bit bearish type of orientation. But if you remember what was the final assessment, I'm going to refresh your memory right away. Um, I still think, especially getting into August and September, that this market is setting up for a little bit of a bounce on a macro scale, but it takes time, so maybe it's not really the moment yet. But I will keep on looking for evidences that this market wants to stop a little bit from going down and having a little bit of a relief rally. All right, we'll see. And so, it looks like at the end of it, it took a little bit of time, right? But we got that little bit of a rally in the DXY. Now, of course, right, we broke this high. We immediately pulled back, especially after the volatility with the news in between the FOMC and then NFP and all the revisions. And we've seen the dollar or the DXY closing down the week with a little bit of a pullback. Now, so far, the pullback got back in a level which was, kind of relevant lately. So we'll see how this level react now. Uh, if we put it all in the context of a VIX, which is now, trying to attempt a little bit of a bounce. So with a little bit of volatility, or more expected volatility in mind, I'd say it wouldn't be unusual to see these maybe on Monday trying to spike a bit lower. But I guess that's really the test, right? We are gonna see over the coming week if we really reversed the trend as for the DXY, and we're gonna keep on making now higher highs and higher lows, which by the way it would, I mean, I've been particularly vocal over the last 1 month and a half maybe. I've been particularly vocal in saying that I was expecting a macro bounce in this asset. So I guess this is a time where you try to look for confirmations of that pattern actually unfolding that itself. We'll see about that. Now, I think whether it really goes to the upside or it keeps on, it just resumes the trend to the downside. Both ways, I would expect a little bit of volatility, especially in the month of August, right? So you might see the charts not only for the DXY but all across the board to get maybe a bit messy sometimes. But at this point, standing by my own words, I got the confirmation that I was seeking for, right? If you remember, we were looking at new lows, okay, trend continuation. Can we finally break a high and establishing a higher high after a higher low? Then at this point you might start to think of trend reversal. Look, there is one other point which again it makes the whole thing a little bit trickier than what you might expect. But we also hinted at the fact it wasn't about the DXY, it was about something else last week. But um, we talked about dip swings or relevant swings, right? So overall, at the end of the day, uh, you might look at a bounce in the DXY, but remember that the swing in control of the entirety of this movement to the downside here, right? It still is one right here, okay? So if you see the DXY keep on going on grinding to the upside, let's just remember that at least in my view, this area right here, it could be kind of relevant in order to establish if we really have some sort of a huge macro type of bounce, or if we hit, let's say, 101, 102, and we just pull back once again. We'll see about that. It's too early to tell. But for now, at the very least, what I would say is that we got those evidences of a trend reversal, at least on the daily time frame, right? So we will take it from there and see how it develops itself, right? So while editing, I just thought about a thing, and I think it's a tiny curiosity. It could be controversial. Surely it could be the origin of many different debates. But I just thought I'm gonna throw it out there just for the sake of it. But look, you remember everyone is talking about money debasement. Now we are talking about the dollar here, but it is true for every other fiat currency, right? When they say the dollar lost 100%, 90% of the purchasing power. Therefore, the money is being debased. It goes for the dollar, it goes for the euro, it goes for the yen, it goes for the British pound. Every single fiat currency, it's supposedly debased, right? Now, the first point would be, I know it might seem like splitting hairs, right, and talking about semantics, but when you think about the mechanics, right, if you want to debase a currency, I would think of debasement more what was happening at the times of the ancient Greeks or Romans, right? When you actually have physical coins, whether they are golden or made out of silver, if you dilute the amount of quantity of silver and gold in those coins and you substitute the with another different metal, at that point you're looking at a coin which is not 100% gold or silver. That's what I would call debasement. What I see here, and I know I'm a contrarian on this type of topic, I know it, but I would say this is more inflation than actual debasement. All right. Now, there is a difference, okay, in debasement versus inflation. Inflation, right, it's just I know the effect at the end of the day, it might be perceived as similar, right? But when you think about the mechanics of the current system that we got, the fiat currency system that we have, and you think of the fact that we are living on a debt-based system, right? And what do we talk about when you look at rates and yields and inflation and all the rest? We always say yields and interest rates are just what? A representation, a reflection of inflation and economic growth, because those are the two driving factors for the economy, right? But you can't have one without the other. So in a way, even if your currency is being inflated, all right? Now you can think on one side, yeah, it's just the evil government which wants to inflate away the currency in order to be able to pay down the debt. Otherwise, they know it couldn't be sustainable, or they're just exploiting your labor, your sweat, and your blood, and they're paying you with something which is losing purchasing power over time. Okay, I totally get that argument. I'm not arguing against it. I'm just saying maybe that's not all there is. Because if you look, first of all, the real broad dollar index, so the relative strength of the dollar against other fiat, the first thing you might say is that over the last 25 or 20 years, the dollar went up against its peers. So you might moan about the dollar losing purchasing power, but you got to remember it's a relative system, and fiat versus fiat actually matters. So other countries are in a far worse shape than the US or the dollar. And when you think about the game in relative terms, even if your currency sucks, up until the point it sucks a bit less than the others, you still get the edge over the rest of the world, right? So, first point. I know it could be marginal, but still worth consideration. Secondly, when you think about debasement or inflation, think of, if you have inflation, right, and therefore it, it's not really my definition, but let's stick to it. If you want to look at inflation as the money supply going up, right, you look at M2 as a broad measure. Although it's faulty, it's flawed for me, it's not really an accurate measurement, right? But just for the academic debate, you got M2 going up, therefore inflation. But what if the economic output, as measured by GDP, is going up faster than the rate of inflation? as we are trying to define it in here, right? Are you, beside your, prejudices or concepts, think about the entire thing in these terms. It might be you got inflation, but up until the point economic output is higher than the inflation you're suffering, is your standard of living better or worse into the future? And I would argue, if you think about yourself living in, I don't know, in the 50s or in the 60s, are you better off or worse off if you're living in the 80s, the 90s, or the early 2000s? I would say standard of living actually improved. Now, after '08, and especially over the last 15 years, we might have been looking at a reversal in that dynamic. But on a principle, having M2, therefore inflation going up until the point it's going up at a slower pace compared to economic output, that is not necessarily a bad thing for you. Sure, things are going up in price, but it is also true that more jobs are being added. More people can actually get a job, get a salary, get a wage, get a paycheck, being able to consume, to spend, to participate, to make and meet and whatnot. So inflation, it's not, as they say, it's not a bug, it's a feature of the system. But up until the point specific conditions persist, it's not something which is going to be uh, in absolute terms negative for you, right? So inflation, it's something which comes and it goes hand in hand with economic growth. So to all those people which are calling for deflation, look, be very careful for what you ask, because you might get it. And let me tell you, if you if you look back in history, every deflationary event, it wasn't that cool for the average Joe. So I know it's a little bit like choosing the lesser evil here, but what would you pick? A rate of inflation which is constant, and surely it's going to the upside, but would you pick that with economic growth which is raising faster than that, or would you pick the deflationary event where you got businesses going bust, people get fired, people losing their jobs, people unable to make ends meet? What would you pick? Asset prices going down, deleveraging events, liquidity issues. What would you pick? All right. And I know over the last few years, especially after the pandemic, the entire thing really it got out of hand, right? I get it. But even then, right, let's have a look at these, right? If you look at M2 as a percentage of GDP, even throughout the pandemic, it never exceeded 100%. That means, if you look back, you never had M2 growing faster than GDP. Because even throughout the pandemic, it was artificial, the amount of spending that was done by the Inflation Reduction Act and all the rest. But still, if you don't have M2 growing faster than GDP, you're not really looking at a debasement per se. All right. So, you got to remember, although we were all locked up in a cage, right? Couldn't go out. But if you look 2020, 2021, we got inflation, but look at the nominal GDP. All right. So I guess this is something to consider at the end of it. All right. M2 keeps on going higher and higher and higher, but so does GDP. And now, what remains to be seen is that we have a break in this relationship. And at that point, then you might really say, okay, now the M2 is going up faster than economic output. So now I'm really losing purchasing power, which I totally get it. For a huge chunk of the population, not only in the US, but in the rest of the world as well, this is true. We have a split type of economy, the haves and the haves not, and all the rest. But if you want to look at it, in the broad sense of the term, it's not so black and white in my view that we are witnessing money debasement per se. We are witnessing inflation, which is one thing, but it's not necessarily in absolute terms a bad thing. Okay? And as you can see, of course, there is a huge and very good correlation in between the money supply increase and the economic output, because in the system we got, we need money elasticity. Think about it for a minute. If we didn't have a currency which was elastic, or a money supply which was elastic, how could have you fueled the immense amount of prosperity and economic growth that we have seen with the process of globalization. If you don't have new money be able to fund new productive investment, how could it be that we were able to industrialize the countries that weren't? How could we be able to build back up Europe after World War II? How could you have global markets be opened up, global trades? So again, I'm not saying the system is perfect. I'm just saying the system as it is, it worked in that context, and the elasticity of the currency actually helped a lot. Am I saying the system is still perfect? It's still performing, sorry, at that higher level? No, I think the system is broken, but I'm just saying this is how the system should work normally, and why this system was so good, and we witnessed over the last century, we have witnessed the greatest amount of improvements in standard of living and economic output globally in the history of mankind. Now, you might be a critic of the system as long as you want, but this system gave you the type of life and the standard of life you got now. Now, you want to argue that the system is now broken and it needs to be changed. Absolutely. I don't think the system is performing now as it was performing in the past. Surely there are cracks, there are things that would need to be fixed, some things that are now way out of whack. But I always say, especially when I got debate with Bitcoin maximalists and whatnot, before you know being proponents uh, for a new system, I guess you should really understand how the current system works. Because if you don't know how it works, and if you don't understand what the flows are right now and why everything it looks like going south, it's hard to come up with a new system. Again, you want to bet on a deflationary currency, but the reason why we got that standard of living being pumped up so much, it was because we didn't have a deflationary currency. The reason because we abandoned the gold standard, maybe it was Nixon. Maybe the US realized they couldn't just pay down. They didn't have the gold to back up all the new currency units they issued. Maybe the new currency units created, it wasn't necessarily created by the US government or the Fed, but it was the Eurodollar system, the real system. Not government, not central banks, right? I just thought, something to think about. And then, you might come to your own conclusion. I'm not saying you should embrace my view, but just maybe offering a little bit of a contrast if you wish, right? All right, that was a nice parenthesis, I guess. Now, moving into currencies or foreign currencies, of course, what you've seen is basically the opposite, as expected, right? So the euro had these 3 days where it literally plunged. A little bit of a rebound on a Friday because, of course, the DXY came down like a lot. Now, I think there are a few moving parts in all of these because now the people are wondering, okay, but if the dollar was set up to go higher, right? Why did we see that coming back down and the euro rebounded that much after these three impulsive days to the downside? And same it could be for the yen or for the Swissy or for the Canadian dollar and all the rest. Well, first of all, I'd say it's always the same. Market inefficiencies tend to be rebalanced. Um, as we've said in the past, the farther it goes, the weaker it gets. So, you always had a little bit of a stitch up, especially when you break uh, key lows or when you violate key swings on a higher time frame. All right. So again, it could be just the mechanical type of a reaction that you get. So, which is why I'm saying we need to look at it and to keep on monitoring what is going to be over the coming week and potentially the entirety of August, right? But it is also true that, again, another little bit of a spoiler alert, but we've seen equities, US equities, selling off particularly harshly. The point could be when as a foreigner, and we know the amount of inflows when it comes down to capital, right? The amount of inflows from foreigners into U.S. equity markets has been huge, and was one of the main contribution to the equity market keep on going higher and higher, right? When you got a sell-off like what we got recently over the last 2 3 days, if foreigners are selling, they are selling stocks and they're getting dollars because those are US dollar denominated assets. But if you want to then get back those money into your local denomination after selling the stocks and getting the dollars, what you need to do? Well, you need to sell the dollars and buy back your own currency. Could be the euro, could be the yen, could be the British pound, right? So these kind of a bounce in the euro, the pound, the yen, maybe you could attribute it to something like it, right? But again, it's too early to tell. We just had a little bit of a spike in volt, so don't be too quick in judging things just for a few days of a sharp movement, right? Now, well, sure, they are foreign currencies, yeah, but let's call it the alternative or the BRICS or the exotic currencies. They basically did the same. Um, the Chinese yuan had a big drop, in my view, but even bigger was the Indian rupee, which is now looking like the weakest of the pack. Um, the Brazilian real, no matter what, it keeps on being the best looking chart among all of these. And what else? We were talking about the ruble, right? The spike to the upside, the exhaustion, it got back in the range, starting to hovering around the low side of the range. And what we said was, well, that's usually a sign of weakness. Lo and behold, we got this huge movement to the downside. Now, again, we got the bounce right after a lot of different events with, Trump threatening new sanctions on Russia, and now apparently moving to nuclear submarines toward Russia territorial waters. For whatever reason, I don't know. I don't want to get into that. I'm not a good material for doom and gloom, right? But it was nice to see that again. These type of behavior played out again, even in an asset like the Russian ruble that I'm not particularly familiar with. Price is price is price, I guess, at the end of it, right? Now, let's move on into oil. Oil was nice because there was a very key point we made last week. Although it was looking weak, my own bias was weak, but, you know, there's always that point about confirmation, right? Let's check that out. Like this one still, as I said, I tend to be bearish biased on oil because of macro factors, global demand, global growth, and whatnot. But this week, especially from a price action standpoint, it just confirmed maybe a bit of weakness. Sure, sure. Up until the range is not completely broken, uh, just be aware. You don't want to be the guy which is gonna short right around the potential, range low. Therefore, you basically sell the bottom of these consolidations. So just and lo and behold, what you see is oil closing down very weak, low side of the range. At support, you could say, at least, recent support. What you get? Massive spike to the upside. Now, of course, you can say there might have been something particularly relevant on the fundamental news, or it could be whatever you. Point being, you didn't know what the trigger could have been for an upside move like this last week or last weekend. What we did know, it was just that if this is current support, you don't want to be the guy selling at support up until the point the support is actually broken, right? So again, the importance of confirmation, especially on higher time frame for me, is always key, right? When it comes down to risk management. So we got this little bit of a spike in oil. It got up to into the 70, yeah, 70 even more or less on a closing base. And then, of course, with the data and with the volatility, it came back down. So all in all, if you just look at the weekly, Yeah, it looks like, again, so far, take it with a grain of salt. We are still in the context of this range, but it looks like an attempt to break out of the range to the upside, and so far it was rejected. We'll see how next week shapes up. You could still build up the case that, although slightly, but this could be taken as a higher high relative to this one. Sorry, higher low, and this, of course, is a higher high relative to this one. And therefore, you could still build up the case for oil to keep on grinding to the upside. I'm not sure. To me, it's just you know, it's not. It's not a move that I would be particularly confident to call for continuation, because I don't like to see this level of don't want to call it failure right away, but this sort of a fade move, right? Like it's not your normal push to the upside, and then a little bit of a slowdown, a little bit of a sideways action, and then again continuation. It looks more like a fade, although again. Might be volatility due to the news, the macroeconomic data points, and whatnot. So I'm I'm really not decided on what I do think about oil. I still maintain my fundamental premise, and again, as we've seen in the economic calendar section, if the economy in the US and globally it's slowing down the pace, I I wouldn't feel confident in building up a case for a massive surge in oil prices, right? Because energy is the economy. If the economy is slowing down overall, you should see tamed demand for energy. So still, I'm a little bit in the limbo because fundamentally, I would say my bearish case, so my case for oil to keep on trading a bit lower than this, it's still on in my view. But again, fundamentals, they could take months to play out, while instead the short-term fluctuations, they're all driven by, knee-jerk reactions, economic data points, geopolitical events, especially with oil, and as usual, liquidity dynamics. So I would say I keep on being kind of neutral on oil, and I'll take it as it goes, right? So from here, let's move into gold. And even with gold, if you remember, at the end of the day, the bias was still to the upside, even if it didn't have a particularly good week last week, right? So let's move on to gold. I'm still, all in all, bullish oriented on gold, and my point of invalidation for these upside movement or momentum, it remains for now the June lows. In another week, probably it's gonna be the July lows, so this low right here, and you keep on raising it month by month up until the point something drastically changes. All right, so at the end of it, if you try to picture a trend line here, an horizontal trend line, and again a diagonal in here, still it's looking like an ascending triangle, which has not been broken to the downside. So I need to keep on being bullish biased. Although we got our points of invalidation for potentially a further movement to the downside, but up until the point it doesn't happen, the trend is the trend. The so to speak, the pattern, it's the pattern, and the fundamentals are the fundamentals. So it's hard to be bearish gold in my view for now. Now, what you see is that we closed last Friday on the weaker side, right? Then we took out the previous weekly low right in here. We traded below it for a little bit on Monday, but we closed above it. And then we open and close above it on Tuesday. I think because this is a future chart, and of course you are looking at the continuing or the continuous future, so there might be a little bit of adjustments from time to time, but you got the chart opening up at this level, kind of gapping up, and then coming back down. But at the end of the day, Thursday and Friday, we've seen gold pushing to the upside. Now, I don't know if let's try to look at the spot chart for a minute. Yeah, I mean, it's kind of the same. Same drop on Wednesday, and then Thursday and Friday push to the upside. Of course, you don't have those quirks when it comes down to the adjustment. I don't know. Maybe I'm not sure. I didn't check. I don't know if we switched the contract for gold right in here. What if you back adjust it? Yeah, now it starts to look a bit more like the spot chart. Sure, the levels are all messed up because of the adjustment, but yeah, I mean, at least we got the same type of pattern, right? I normally don't look at back adjusted charts, but it is what it is. At the end of the day, the premise stock, in the sense that no matter the short-term type of pullback, it was maybe a bit scary. I don't know. For some, could have been. For me, it wasn't, right? But we were still upward biased oriented, and it looks like so far gold it's still trying to push toward these highs, and every time it's brought back down you immediately find buyers. So again, can't really be bearish on gold. It's kind of one and the same. The chart is still technically bullish in my view. The fundamentals are still on the strong side of the case for gold, and I keep maintaining my bullishness on gold so far. All right. Now let's have a look at Bitcoin instead and remember what we were saying last week, right? I'm just saying, the signature that I see here as for the price action, it's not really that type of pullback where you say a lot of people might have been shaken out. All right. That's what I'm saying. I would expect a bit more of a deeper pullback if you want to shake out the weekends at the table on the long side of the book, and then creating the liquidity to reaccumulate and keep on pushing to the upside. Uh, and again, does it have to happen? Does it mean that you can't really buy or add to your positions in this range if you don't see that type of pullback? No, it doesn't mean you can't. It just add a little bit of a potential risk of buying too high. All right. So now point might be, is this I'm quoting Star Wars. So we said this was not the pullback we were looking for. Is this one the one? So um maybe. I mean, surely it's a bit more substantial than the previous one, which was quickly reabsorbed. We are trading kind of in this pocket of inefficiency right in here. Mm, I'd say, being Bitcoin a 24/7 market, I guess it's totally possible that over the weekend, so it's Saturday morning now, so it could be from here to, tomorrow night, you might say another tiny attempt to the downside, and then we'll see. To me, although, I said that a good type of pullback to wash out a bit the weekends at the table and engineering more liquidity to then reaccumulate and trying again to the upside. To me, that was a scenario which was plausible, and I didn't think that this one was it. Okay, but nonetheless, um, we did also say that up until the point this area, this sort of a base right here is holding, you shouldn't be catastrophically bearish on Bitcoin overall. Still, if you look at the chart, it's still a chart which is going up. It's still a chart which is showing bullish intentions. So, I mean, for the medium term, when you talk about maybe next month, next 2 months, next quarter, you might still say we are on the go for more upside, right? So nothing really broke in Bitcoin in my view. So yeah, short-term pullback, why not? We got these impulsive run up, exhaustion, price pause, a bit of a pullback, and then we keep on going higher, right? Up until the point you don't see it breaking back below these levels, and at that point we might start to look at different scenarios. But the point at the end of the day was, look, considering the chart, it's still overall bullish. The only caveat you might get in the scenario where you want to assess, so what do I do? Do I buy in this range for continuation, or do I wait for a pullback? But what if then the pullback is not coming and it just keep on going higher? I am missing my chance to add or to buy in. So the only assessment was, look, there is nothing wrong in doing one or the other, depending on your disposition. The main caveat for me was, just remember, if you accept or if you're willing to buy in this range right here, hoping for an immediate continuation to the upside, the only additional risk you're taking is buying too high because we didn't have some sort of a rebalancing move to the downside or a pullback or a little bit of a pickup of fresh liquidity to the downside. No inventory is being picked up. So it's not, I guess it's not uh, philosophically, so to speak, wrong to keep on buying it and accumulating it right in here. Let's just bear in mind that you are taking on additional risk, what in technical terms you could define as gap risk. I know there is not a traditional definition type of a gap in here. I'm talking about a gap in an efficient delivery, which, by the way, incidentally, it looks like when you look at it from the standpoint of efficient versus inefficient, we just came back down, yeah, in the middle of that inefficient delivery right here. So, I mean, is it enough? I mean, if you want to be bullish on Bitcoin, which quite honestly, I'm still, I'm still bullish on Bitcoin. This could be enough for a pullback, uh, especially coming over the weekend, right? At the same time, would you say it could still give another little attempt to the downside, completely balancing out the entirety of the upward move? Yeah, absolutely. So what do? Do you just layer your entries in the area and try to average your entry price somewhere in this range? Or do you wait for price to actually retest the previous base and then you look at the reaction? That is up to you. Same as last week. Um, at the end of the day, if you have a long-term view on it, and at the end of the day, if the chart is still bullish, what you need to manage is just your personal preference and personal risk appetite, right? But so far, there is nothing catastrophic happening on this chart. It's just a pullback for now, and I would maintain my bullish stand of Bitcoin for the next, few weeks ahead. All right, let's just leave it at that. Now, let's move on into yields. Nice plunge, especially on the short and medium end of the curve. Um, Throughout the week, we've been looking at what? This tiny little divergence in here, right? The short end actually making new highs relative to the nearest short-term high, while the other two didn't. And at the end of it, we got the plunge right after the press conference, I guess. So, what might be the point? I think, at the end of the day, the market, at least, by the look of it, in my view, it, it just saw through what Powell was saying throughout the press conf, and I think they read it a little bit on the hawkish side of things. So, you know, maybe this is it. And therefore, they pair it up with NFP and all the rest, and they just started to price in lower growth and inflation expectations into the future. So could it be this is the bond market looking through what Powell is saying, looking through what the stock market kept on saying up until 2 days ago, and now saying, you know what, if Powell doesn't want to cut rates, we are going to show him the path ahead. Because again, we looked uh, at the correlation and the leading lagging relationship in between the 2 years yield and Fed funds, and we've seen that historically the 2 years it's leading Fed funds, right? It's always moving in anticipation to Fed fund, and Fed funds all in all always follow what the 2 years is doing. So this could be the bond market sending a signal to the Fed like, dude, you didn't cut, but if you are not convinced, this is our way to tell you, yeah, maybe you should have, and if you didn't, next time you come on the podium, we hope you take the right decision. Could be something like this, right? So I mean, again, I've been maybe on the contrarian side, but I guess now again, this is another thing that I kept on repeating and repeating and repeating up until the point I was blue in the face. I was expecting lower rates going ahead because at the end of the day, I subscribe to the idea that rates are not necessarily a tool to influence economic growth, right? I don't see the mechanic where you lower or raise rates and therefore the economy or the economic output responds accordingly. I see it in reverse. I see the economic output doing what it has to do, and I see then rates following it. So slowing economy, lower rates. Red hot economy, higher rates. But to me, not only there is a correlation, sure, but the causation effect is in reverse. I don't think that policy, can influence the economy. I do think at the end of it, it's the economy which influence policies. And although policymakers don't want to acknowledge that because they think they are the gods of the markets, overall, in the long run, the market is always right. So I keep on maintaining that view. So we've seen, of course, bonds catching a bid, which, if you think about the inverse correlation in between the bonds and the DXY or the dollar as measured by the DXY, that's yet another thing which could explain why we got that sudden, it's not really a crash, but let's call it a pullback, right? On Friday, because we got a collapse in yields, and therefore bonds catching a bid and the dollar going down. So there is some sort of an historic relationship that we got. And remember, I'm going to stress it out once again, you really need to be particularly worried only when you see bonds going up, yields going down, and at the same time the DXY going up, right? That's the no bueno zone, okay? Because not only that means that everyone is looking for the safety and liquidity of the bonds, it also means that you got a dollar shortage going around in the system, okay? So most likely a deleveraging event somewhere. It's kind of the same of when we were discussing the yen and the DXY, and we said the bad scenario is when you see the DXY spiking to the upside and the yen spiking against the dollar, because those are two currencies on which a huge carry trade is performed, right? You think about the yen carry trade, well, the dollar is even a much bigger carry trade than the yen. So when you see those two spiking against other fiat currencies, and you see the yen spiking against the dollar, again, that's another no bueno zone for the leveraging and all the rest, and liquidity issues and whatnot. I think it's kind of the same when you see bonds up, yields down, DXY up, right? So that would be it before jumping into equities. So let's move on. All right. I don't necessarily want to spend a lot of time on stocks, but let's just look at the heat map to get a little bit of a view of what the week was. Yeah, of course, the market came down a bit, but what kind of held was, of course, Microsoft, Meta, to some extent Nvidia. So, the usual suspects, right? Now, this is interesting. I guess if you check and if you remember, we got earnings report this week. So, I mean, we were expecting a decent amount of bit rate. So Microsoft, of course, if you look at the estimate, I know it's a bit tiny, but Microsoft, of course, it was a bit. The revenues, earning per share, it was a bit. Meta, of course, it was a bit, right? No doubt. And then we got Amazon, bit, earning per share, bit. And then we got Apple, which was, of course, a bit. And earning per share, bit. So look, the point is that those companies actually held up pretty well. And, beyond the simple fact that they beat expectations as for revenues and earnings and all the rest, especially when it comes down to Meta and Microsoft, I don't know if you check the capex. So the amount of money that these guys are willing to spend keeping on building up the AI infrastructure, it's huge. It's really huge. So the entire theme about the AI bubble and whatnot might be a bubble, might be not. We'll see in the future. And so far, what you look at is a market where the breadth, again, it's really narrowing by the day. But if you think about how weighted these big tech, these big caps are in the index, what you are looking at right now with this little bit of a pullback, it's basically just, in my view, a little bit of we were talking about rotations, right? So remember that just because the market overall could go down, right? That doesn't mean that all the market will go down, right? But speaking about the market broadly, we have seen a little bit of a pullback. Now, again, is this the end of the bull market? I mean, let's just look at this. From the peak down to the low of the week, ES futures got down 3.50%, and NQ futures got down by 4.5%. If you remember, we have been spent the last 3-4 weeks talking about, look, the market is going up. We are looking at some cracks starting to, transpire right now. So don't be surprised, especially if you consider seasonality and all the rest, if we see a correction, especially good months from a seasonality standpoint for a correction would be August or September. What type of correction could be? I remember I said in between the range of from 4, 5 to 6, 7%, talking about the S&P right now. So we came down 3.5 for now. We closed the week below the 20 days moving average, and we got potential support below it with this cluster of price action from before, from the past, but also from these moving averages right here. So the green is the 2055 on daily time frame exponential. The red is the simple moving average 50 period on a daily. So I mean, we got a potential dynamic support right in here. So what it could be, things you want to monitor is, do we test into it and then we bounce and we get back to the 20, and then at that point, can we reclaim the 20 right away, or we get rejected for a much prolonged and ordered type of a distribution, aka pullback? Or do we immediately bounce back, opening up the week next week, and we get rejected at the 20 days moving average, and then at that point we go down, testing the lower moving averages? So I mean, we'll see what's going to come at the open on Monday for sure. I think a lot of what we got, as we were talking about, what we were saying, there are many risks, there are many cracks. We were talking about the labor market, we were talking about the exuberance, the zero DTA options volumes, sentiment, all the rest, if you remember last week's video alone. But what we said, it was, look, you need a catalyst for all these risks, for all these things to actually become actionable. Now, would you say the huge revisions in NFP right after Powell said everything is cool, right? Would you say that was the catalyst? It could be, right? It could be. Why not? Look, the thing is that let's have a look at a few charts right here, right? A few slides, as we have done for the rest of the month, the previous month. The thing is that, as for the reports from earnings that we got, as expected, we got a good number, or a good percentage of beats, right? So nothing to be worried about there. Fundamentally, the stock market, it wasn't bad. So it wasn't. I think this pullback, if it's gonna be a little bit more prolonged, it's not due to earnings, in my view. Earnings came in kind of as the market was expecting them, if not better. Now, sure, we argue the fact that it's easier to beat expectations if you revise them so low, if you set the bar so low, right? Now, we also seen that we are coming out of a period where volatility is particularly low. And we have been discussing this thing for a while now. Volatility is designed to contract and expand. So when it gets so low, there's only one way it can go next, right? And I guess last week it touched into the 14s, right? And last time I checked, it was yesterday, it was around 18. So a little bit of a spike in vol as for the VIX. But that's nothing particularly huge yet. We'll see. Okay. Now this is interesting. If you look at the seasonality as for the VIX, so July it tends to be a not particularly volatile month. And then again, August, September, it tends to be a bit more volatile. And so you got the historical average. Now, you got in red what have been 2025 so far. Sure, we got a bit outlier in April with the Liberation Day and all the rest, but all things considered, it looks like, at least so far, if you exclude the outlier, right, news driven and all the rest, geopolitical events, oh, so far we are on track for what the seasonality pattern for volatility would be. And remember, volatility is usually higher when you got a market going through a little bit of a turmoil, right? So nothing to be surprised at. Again, the market was seeing a huge, a decent amount of advances, right? We have been staying above the 20-day moving average for a while, right? Historically. So what goes up and up and up, at a point you need that type of a pullback. The market maybe just taking a breath, or maybe buyers leave lower, sellers leave higher. So maybe there was no more buyers willing to buy at those higher prices, and the market price just needed to come back lower, seeking buyers lower because they leave lower, right? This is the monthly returns, the statistics for the S&P for the divided by months, right? And as you can see, August and especially September, of course, those are two of the weakest months of the year. So again, should you be massively surprised if we just started the month of August and we are witnessing a little bit of weakness? Again, it's just the first month the first day of the month. We'll see about the rest of the summer, but it just don't be surprised at the end of it. And again, a little bit more of the recent last 10 years of seasonal pattern for the S&P. Just another testimony that August and September are not particularly strong months for the S&P. So again, nothing particularly new, nothing to be massively worried about yet, right? And again, back to seasonality for August. And here you got all different type of time frames since 1950, past 20 years, past 10 years, and most importantly, post-election year. Look at August, post-election year, right? And again, if you want to talk about the election cycle, looks like we are kind of trending the same direction. You usually see a peak in August, right? And then September, maybe the beginning of October, being a little bit more on the weaker side. That just goes for post-election year, as far as I understood, right? But still, it fits the average seasonal pattern, right? We were looking at CTAs being particularly exposed last week. When we were looking over them, they were in the 90%. They got up to the 100%. Another testimony that whoever could have bought already bought. So again, should you be surprised if we now have a little bit of a pullback, right? And again, the exposure once again as for the computer trading algorithms, right? So all in all, just to say that shouldn't be surprised about this pullback. We'll see how it's gonna proceed over the coming weeks and the rest of the month. But for now, I would say just look at the moving averages. It could be a simple tool to assess what's going to come. And I guess, we finally have a little bit of a pullback, which is nothing unusual. It's nothing that couldn't have been forecasted. And I say so far, we'll see next week, but so far, it's nothing particularly worrying, right? We could go down another 2% on the S&P and I wouldn't be worried yet, right? I'll just leave it at that for the week. I think the video is already long enough. There is nothing to be added. So with that, I'm going to wish you a good rest of your weekend, and we're going to talk again next week. Up until the point, be nice and be cool. Neil's out.
What have I told you since the first day you stepped into my office? There are 3 ways to make a living in this business. Be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.